Welcome back to the deep dive. Today we are opening up a stack of sources that give this really deep practical masterclass on a trading concept called supply and demand zones, or S&D.
Right.
And look, for anyone who has stared at a chart just wondering, where is the big institutional money hiding? This is the deep dive for you. Okay, let's unpack this.
Let's do it.
Our mission today is to bridge that gap between, simple economic theory and what you actually do on a chart. High probability technical charting. So we're going to cover how to find these powerful zones, but I think more importantly, we're drilling down into the three absolutely non-negotiable rules for validation.
Yeah, filters.
The filters. These are the rules that separate a trade you should just ignore from one that could, offer a 7-to-1 reward ratio.
It's a fantastic mission because this whole system, it seems really technical, right? But it relies entirely on the most basic engine in all of economics.
It all comes back to basics.
It does. If you really understand why a price moves, you have a much better shot at predicting where it might turn.
So let's start right there. The foundation. We're talking basic scarcity. This drives every single market. The source material uses gold as the classic example. How does that interplay of supply and demand actually move the price?
Well, think about it really simply. When demand for gold suddenly spikes, maybe, there's some global uncertainty, what happens?
Everyone wants to buy it.
Everyone wants to buy it. They start buying aggressively. And every ounce of gold they buy is an ounce taken off the open market. So as that available supply just shrinks, the asset becomes scarce.
And scarcity is the key driver of value.
Precisely. That scarcity forces prices higher. You have more buyers fighting over fewer units, so the price just has to rise until, demand cools off or maybe a new supply comes in to meet it.
It's a feedback loop.
An unavoidable one.
So what happens when that loop flips on its head?
Then you get the reverse. People start selling their gold. Maybe the geopolitical situation calms down, demand drops. All of a sudden, there are tons of units available on the market. Supply is it's flooding in relative to the desire to buy.
So high availability means low scarcity.
And low scarcity means the price depreciates. It has to go down. What's fascinating here is how simple the underlying economic engine is before we even look at the charts. The price you see on a candlestick chart, that's just a visible record of this tug-of-war.
Between buyers and sellers.
Exactly. And our supply and demand zones, they're just the fingerprints left behind when one side wins that tug-of-war in a big, decisive way.
Okay, that is the perfect bridge from theory to practice. We're looking for where that win happened. We translate that pressure into these S&D zones. So what's the pattern? What are we looking for on the chart?
The structure is very specific. A valid zone is always a period where the price action just sort of slowed down. It stalled, it consolidated. It might be for a few candles, sometimes just one. And this is crucial. That period must be followed by a huge, fast, impulsive move away from it.
Let's define the two types of zones that come from that pattern. First up, the demand zone or a DZ.
A demand zone is that quiet area, that consolidation that happens right before a major up move.
Ah, so that tells you something.
It tells you everything. It says that buyers saw that price level, they thought this is dirt cheap, and they just poured massive amounts of capital into the market. That's what caused the impulse. We call this a discount price level. It's where the smart money loaded up.
So the idea is when the market comes back down to that demand zone later on, the expectation is that a second wave of buyers will step in.
Yeah, either the ones who missed it the first time or the original buyers who want to add more to their position. They see a second chance to buy at a discount, and that can trigger the next rally.
It's like a hidden spring of buying pressure.
That's a great way to put it. Now, the supply zone, the SC, is the mirror image. It's the consolidation that happens right before a huge downward move.
So in this area, the big sellers decided the price was just too high, overvalued.
Exactly. They injected a flood of new supply into the market. It completely overwhelmed the existing demand, and that's what caused the price to collapse. This is what we call a premium price level.
And that's where traders want to sell or short. It's a better entry point.
The basic concept is really straightforward. We want to buy demand zones because they offer a discount, and we want to sell at supply zones because they offer a premium. But, and this is a big, but only when the market comes back for the first time.
Okay, but just finding the general area isn't enough, right? If
Yeah.
you're actually putting capital on the line, you need to plot that zone with pinpoint accuracy. You can't just draw a giant box.
No, precision is absolutely vital for managing your risk and your reward. And the specific rule from this masterclass is to look for the last candle before the impulse.
The last candle.
That single candle holds the highest concentration of all those unfilled orders that we're building up.
But how do you identify that specific candle? I mean, a chart is full of candles. A lot of them look the same.
We're looking for something very specific. It's called an indecision candle. Visually, it often looks like a cross or maybe one of those spinning top candles. The key features are big wicks, top and bottom, but a really, really small candle body.
And why is that visual so telling? What does it communicate?
The big wicks show rejected prices. So let's say in a supply zone, the market tried to push higher, but sellers immediately smacked it back down. That creates the top wick.
Right.
Then it tried to push lower, but buyers resisted. That creates the bottom wick. And the tiny body just means the price couldn't commit. It was a huge internal struggle. The forces were just gathering strength.
So that moment of indecision right before the explosion, that's where the zone is?
That's the epicenter of the whole move.
Yeah.
So once you find that indecision candle, the rule for plotting it is simple. You draw your zone from the absolute high to the absolute low of that candle.
Including the wicks.
Including the wicks. They are essential. Now, the source material adds one little caveat. If the very next candle's wick pokes out just a tiny bit past your indecision candle, you can extend the zone to include that too, just for maximum coverage. But the zone always originates from that last indecision candle.
Okay, so defining the zone is the groundwork. But like you said earlier, these patterns appear everywhere on a chart. If you just traded every single one, you'd blow up your account pretty fast.
Oh, silly.
The real power here seems to be in the filters.
Yes.
We need these validation rules to cut through all the noise and just focus on the high probability setups. So let's get into rule number 1, which is the biggest filter of all: context.
Context is everything. I mean, it's the first thing you have to do. Determine the overall market direction, the dominant trend. You have to trade with the trend.
So walk us through that. What defines a healthy trend in technical terms?
An uptrend is just the market making a series of higher highs and higher lows.
Okay.
AHH and AHL. Think of it like a staircase, just stepping up, up, up. If you're in that environment, your job is simple. You only buy demand zones. You have to completely ignore every single supply zone that forms on the way up.
Even if I see one that looks perfect, like a textbook supply zone during a huge rally, why is it so important to resist that?
Because in an uptrend, the underlying momentum, the big money, is overwhelmingly bullish. That perfect-looking supply zone is probably just a small pocket of people taking profits. The probability that the huge buying pressure will just smash right through it is far, far too high to risk your capital. You're trying to step in front of a freight train.
You're fading the flow. Okay, so if the market structure is showing a downtrend, making those lower lows and lower highs, the LLLH pattern, the opposite is true.
Exactly. The staircase is stepping down. In that structure, you only sell supply zones.
Okay.
You must ignore all the demand zones. Trading against that structural trend is, I promise you, the single fastest way to find a string of losing trades.
Okay, that's rule 1, trend. Now, rule number 2 is about market efficiency, or more accurately, the lack of it. A zone isn't valid just because the trend is right. It needs something called imbalance.
This is one of the most critical rules, and I think one of the most misunderstood. A zone is only valid if it still has an imbalance attached to it.
Can you help us visualize that? Because the technical definition can sound a bit abstract.
Sure. Imagine the price action is a car on a road. When the market is moving slowly and efficiently, the wicks of the candles overlap. They fill in every single price point. It's like driving on smooth, perfect tarmac.
Okay, balanced.
Balanced. An imbalance, on the other hand, is a sign of inefficient movement. It's an open price range where the price moves so fast that the wicks haven't filled that area yet. It leaves this visible gap on the chart.
Yeah.
It's like the car slammed the accelerator so hard it left skid marks.
It's an inefficiency. So why does that inefficiency matter for our trade?
Because that gap represents unmatched orders. The market, by its nature, wants to be efficient. So if price comes back to a zone where the imbalance has already been filled, meaning previous candle wicks have already covered that open space, it tells you the market already fixed the problem there.
Ah, so it's already been repaired.
It's been repaired. The zone is now low probability. If the price comes back again, there's a very high chance it'll just slice right through it, because all those aggressive orders have already been dealt with. You have to hunt for the zones with that visible, unfilled gap.
That is a phenomenal filter. It forces you to look for true, uncorrected power. Okay, let's move to rule number 3. The life cycle of a zone. Because a zone isn't a permanent fortress, is it?
Not at all. It's a finite resource. And the rule is simple. A high probability zone is only good on its first retest, the first tap in. This all comes down to diminishing pressure.
So when the market hits a fresh supply zone for the first time, it absorbs all those built-up sell orders, which causes the price to drop like we want.
But here's the thing. Those orders are now gone. It's like draining a reservoir. The next time price comes back, there's less selling pressure left.
And we've all seen that, right? A zone holds 3 times, you think, this thing is indestructible. And then on the 4th or 5th try,
it shatters, and your trade gets wiped out. That repeated testing is just a signal that the buyers are slowly chipping away at the supply in that area.
they're absorbing the sellers.
Exactly. So the rule has to be strict.
Yeah.
You only trade the first tap. If the market comes back to that same zone multiple times, you have to leave it alone and go find a fresh imbalanced zone.
So those are our 3 core filters. Trade with the trend, make sure there's an open imbalance, and only trade the first retest. Okay, now let's get into the advanced stuff. Because even after you apply those 3 filters, sometimes you're left with multiple valid S&D zones in a single move. And that forces a choice. That brings us to the extreme zone.
Ah, yes, the extreme zone. This is really the crown jewel of S&D trading. It offers the absolute best risk-to-reward ratio. We're talking 1-to-5, 1-to-7, sometimes even higher. It maximizes your profit while keeping your risk tiny.
So how do you spot the extreme zone among the others?
It is the furthest imbalance zone from the current price in that leg of the move. So imagine a big downtrend. You might have 3 valid supply zones on the way down, but the extreme zone is the one way up at the top, the furthest one away.
The origin of the whole move, basically.
That's often what it is. And this is where you can confidently place automated orders, your sell limits or buy limits, because you know you are getting the absolute best price, the premium of the premium.
The risk, I guess, is that the market turns around before it ever gets there.
That's the trade-off. But the reward, if it does tap in, is just so substantial. It's the purest form of the strategy.
Okay, so that's for people who like limit orders and want amazing RR. But what about trading those other non-extreme zones? Or for traders who want more safety? That's where the confirmation entry comes in.
The confirmation entry is like your safety harness. It's a double confirmation for when you're a bit less certain, or when you're not at that extreme zone. You never just trade on the touch. You wait for proof.
And that proof is a structural shift on a lower time frame. What does that look like in practice?
So let's say the market is trending up on a 5-minute chart, making that nice little staircase of higher highs and higher lows, and it's coming up into a major supply zone on your 1-hour chart.
Okay.
If you just place a sell limit, you're betting that momentum just stops on a dime. With a confirmation entry, you wait. You let the market enter that 1-hour supply zone, and then you watch the 5-minute chart. You wait for that uptrend structure to break.
You wait for it to make a lower low and a lower high.
You wait for that LLLH pattern. That little break of structure is your signal. It tells you that sellers are now actively in control inside the zone. But only then do you enter your trade.
So the confirmation trader gets a slightly worse price, but they get near certainty that the reversal is actually happening.
And if that shift never happens, if the market just plows right through the zone.
You never entered, you avoided the loss entirely.
Exactly. It lets you engage with multiple zones without taking on unnecessary risk. A great tool for managing those non-extreme setups. And if we connect this to the bigger picture, this whole framework, everything we've talked about, is fractal. Meaning that whether you're looking at institutional flow on a weekly chart or you're day trading on a 1-minute chart, the underlying engine is identical. Supply, demand, consolidation, impulse. It's the same pattern over and over.
And that fractal nature leads directly to using top-down analysis, which is so important for figuring out your targets.
Yes. You use the weekly and the daily charts to build your main story, your narrative. You use them to find the most powerful S&D zones that are controlling the long-term trend. But you also use them to identify your targets.
And the zones themselves become the targets. It simplifies where you get out of a trade.
We teach people to trade range to range. If you enter a trade from a strong, validated demand zone, your most logical, high-probability target is the very next imbalanced supply zone up the chart.
So you're trading from where buyers were strong to where you expect sellers to be strong?
That's it. You're not trying to guess the absolute top of the market. You're just trading the high-probability rotation between 2 known areas of opposing pressure. It protects your profits before that predictable reversal happens.
It's disciplined. You're using the same rules for your entry and your exit.
It cleans up your analysis beautifully. You get in at a discount. You get out at the next premium. It's risk management wrapped inside economic theory.
That was an incredible dive into applying supply and demand. For you, the listener, the framework is solid. Find the zone by looking for that consolidation before the big impulse. But remember, the location is nothing without validation. You have to filter every trade.
Every single one.
With the dominant trend, with an open, unfilled imbalance, and only on that very first tap.
This raises an important question. The entire system, its whole success, hinges on the fact that this principle of scarcity and the panic buying and selling that comes from it is fractal. It works the same on a one-year chart as it does on a 5-minute chart.
Right.
So, considering that universality, what does the sameness of these patterns really tell us about human behavior? Are the decisions made by an institutional trader moving billions of dollars truly any different from the snap decisions of a scalper on a 1-minute chart? Or are we all just reacting to the same deeply ingrained psychological triggers of fear and greed, just on different scales?
Something to mull over as you watch your next set of candles form. Thank you for sharing your sources and joining us for this deep dive. We'll be back next time with your next stack of sources.